Okay, next is the declining balance method. We're going to use the double declining balance method. We do not deduct the salvage value when we are determining our depreciable cost for this method only. So let's go ahead and look at what we're going to do. Our double declining balance method will be 2 times the straight line. So our straight line rate would have been 20% because we had 5 years under straight line. We take the same amount each year. 1/5 would have been 20%. We're going to double that, right? Double the straight line. So our depreciation we're going to use will be 40%. And we're going to adjust our beginning balance each year to determine that. So let's start off. It'll make more sense when we do it. Let's start off with 2011. So we're going to need the book value at the beginning of the year, which in our case is $60,000. We're going to multiply it by our depreciation rate, which is 40%. And that's going to give us our annual depreciation. So, let's say depreciation. In the year 2011, 60,000 times 40% is 24,000. So we're going to go ahead, debit depreciation expense for the 24,000, and then we're going to accumulate it, right, in accounts receivable. We're going to go ahead and start accumulating our depreciation with a credit of 24,000. Now let's look at 2012. 2012, we need our book value at the beginning of the year. Well, what is our book value? It is 60,000 minus 24,000. That's our book value. At the end of 2012, it's the same thing as at the end of 2011, it is the same amount as the beginning of 2012. So that's going to be $36,000. So 36,000 times 40%, 0.4, is 14,400. Again, depreciation expense is gone, right? Close that out at the end of 2011. 2012 amount is 14,400. And we're going to go ahead and add that 14,400 to our accumulated depreciation. And we want the book value, that's what the question had asked for, book value at December 31st, 2012. So our book value at December 31st, 2012 is the same as it's going to be at the beginning of 2013. So we can go ahead and take our 60,000 beginning and subtract out our accumulated depreciation thus far, which is a 24,000 plus $14,400. So that is going to be 34, 5, 6, 7, 8. That's 38,400. Yes, 38,400. That will give us 21,600. So this is our book value, 21,600 at the end of 2012 or the beginning of 2013. So now again, we're going to have to take our 21,600, multiply it by 40% to figure out our depreciation expense. That ends up being $8,600. Again, 2012 depreciation expense gone. Our depreciation expense for 2013 is $8,600. And we can go ahead and add that on for our accumulated depreciation. So if we want our accumulated depreciation as of December 31st, 2013, we're gonna have to add those three items together. $24,014.04 and $8,600. That will give us $47,040. This is our accumulated depreciation as of December 31st, 2013. Something I want to mention is, of course, although we're not including the salvage value to determine our depreciable amount, we do stop depreciating once we hit that salvage value. We do not depreciate below it. So that's something else I wanted to mention. But that's it. That's depreciation. Hopefully it tells you everything you need to know about depreciation, and we'll move on to another example.